Podcast is now starting. All attendees are in listen-only mode.
All right, I did mention this is being recorded, you guys. So one thing I say at the beginning of all of these webinars is watch it again as soon as we send it out to you. It's going to take a little time for me to compress this and send it off the home base and have them send it out, but you should be getting this weekend probably. So watch it again, because even if you're a more advanced trader, I'm going to be adding some things into this webinar that you will benefit. You're going to have takeaways even if you're an advanced trader, and I'm going to kind of gear it a little bit so that the newer trader, like the beginner trader, can get into this. As a matter of fact, I have this as options for beginners. This is really starting to move on to intermediate, so we're kind of bridging that in, and we're going to be doing several webinars in this course basically, where we've gone from beginners, we're starting to move into intermediate, if you will. So it's going to be beginner intermediate right now. And then after about probably 10 more videos, we're going to be moving into intermediate advanced. So we're going to kind of flow into that and then get into really more advanced trading strategies. And it doesn't necessarily mean, when I'm talking about beginner strategies or easy to understand, some of these intermediate ones will be a little bit more difficult to understand, but I think that they're appropriate for a beginner or intermediate type trader. So keep that in mind when we're going through some of the even more advanced strategies, if you will, are going to be geared towards people that have traded options a little bit more and can deal with those type of strategies, even though they're very easy to understand. So keep that in mind. We've got a lot of balls moving with this and trying to sort this all out to make it so everybody can take something away from it, even if you're not necessarily a beginner too. All right, so let me get a couple of things out of the way. Like I said, this is going to be protective puts, but let me get a couple of things out of the way. My name is Eric Wilkinson. Some of you guys may recognize me as a Wolfman from CNBC, Fox Business, or Wall Street Journal for commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with some money I had earned, trying to get a psychology degree, which I still probably say has been more beneficial to me in trading than even my finance degree that I switched over to. And after graduating college, moved to Chicago and started trading in the pits. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and basically options on all these products and just about every market condition. You can follow me on Twitter at Wolfman's blog and our parent company at ProTraderStrat for various trading information, I guess, if you will. Like I said, this is going to be on protective puts. Now, you can do these in place of stops as well. Like a lot of exchanges are getting away from stops because they're, back in the day, used to be a book. We have people on the floor that would have a book of orders, and those orders were from retail investors and hedge funds, things of that nature. But people would put in their order if they wanted to buy a stock at a certain level. If it ever got down there, they had a resting bid in there for that stock at that particular price. Now, we all kind of do that now online, but what happens is those orders are getting pulled daily, especially on Fridays. People pull all of their orders basically because they don't want to go into the weekend with that stuff on, and they'll just implement it on Monday. But one of the things in and around that is that there isn't necessarily a book anymore, and there's not a whole lot of market depth, if you will. A lot of people are very close to the markets, but once we get way away from the market, there's just not a lot of orders resting in the markets anymore. And that's going to be detrimental to stop people having a stop, because it can just free fall, especially if it opens up below that. There's not a whole lot of volume going on because people are pulling their orders. Those stops can really hurt you more than what they even used to be able to hurt you. But with a protective put, the beauty in that is it gives you a little bit of time to breathe. Yeah, you do have to pay for it, but you can kind of watch the stock and you know exactly where you can get out. It's kind of like a stop limit in a sense that gets elected if you want it to. So that's the beauty in the protective puts. So the protective puts are going to be implemented to protect gains in the underlying. And I like to do this a lot with a stock that's had a big run up in a sense that I've had, makes a nice big run. Maybe it's at historical highs, which seems like just about everything is right now. But you can protect some of your gains. And I like to implement this, a month before maybe an earnings event. So Apple, for instance, might be a really good example. We'll have to look at the implied volatility on it. But Apple has had a nice big run. Now there's starting to be some hubbub or some rumors going about that basically the iPhone sales weren't that great right now. So, that might be a time where you hear something like that, maybe a rumor, and want to put on some protection heading into their next earnings in case that rumor does come true. It just gives you a little bit of peace of mind, but you do have to pay for it. And keep in mind, it is also, you don't want to do this like every single month. If you're really worried about this stock where you're putting on protective puts every single month, it might be just the time to pull the ripcord on that stock and move on, because at the end of the day, if you do this too much with these protective puts, you're increasing what you actually paid for that stock. So if I pay $100 for a stock and I end up buying some of these puts, well, I might pay $1 for the puts that are $10 or $15 below where I bought it. Well, I synthetically ended up paying $101 for that stock, right? If I have that protection. So if you do it too often, you're increasing your basis quite dramatically. So, you need to be a little bit more choosy when you're doing this, as far as I'm concerned. I don't like to put protective puts on all the time. Now, another thing it could be called is a married put, and that's actually usually implemented at the time you're buying the stock. They call that marrying a put, but it is still a protective put, but another way when you're actually going out and say buying Apple today and then buying the put to protect your downside there, then that's a married put. Protective put is usually implemented after you've already bought the stock for some time. Okay. And I mentioned this, implement, the times to take advantage of using a protective put is kind of what we're getting into here, and is implementing it before a binary event. Now, I'm not saying implement this just before the binary event. Say they have earnings in a week and go out there and buy these protective puts. No, I don't want you to do that. One reason is because implied volatility has already crept up. And if you are buying these protective puts in a high implied volatility environment, you're paying more for those puts. The premiums have been pumped up. You're also, if you're got it in your head how much you want to spend on these puts, or how many deltas you want to protect, and I'll get into that in a little bit here in a second. But that if you are doing it with a delta hedge, in a sense, then you're going to be further away from where the market is. When there's low volatility, you can actually get tighter to the market for that same amount of money, and that's because those premiums aren't pumped up as much. And if you implement this like 7 days before that binary event, like I mentioned, you're paying a lot for that premium. Well, after the binary event, and a binary event is just a known event, you guys. It's just something that we know is going to happen, like an earnings call, earnings release. It could be even a dividend. FOMCs are binary events that affect the markets, right? So all of those things are different binary events. The FOMC isn't going to necessarily affect the stocks as much, but it's going to affect the bonds, and it's definitely going to affect the 30-day Fed funds. So all of that stuff, those are different binary events. It's a known event that is going to cause volatility to rise. And after that binary event happens, we're going to see volatility come out, because there's no more wondering, right? All of the cards are on the table in a sense, and volatility comes out. You're going to probably lose a little bit of money on those puts that you bought 5 days in advance. So you want to buy it well in advance of the earnings so that you can actually see volatility expand, which is going to help out those premiums for you. You're not going to feel the theta decay as much when you have something like that happening. So buy it well in advance. If you're, like an Apple would be a good time to start looking at buying those puts in advance of their earnings event. And that's being said that we have low implied volatility around Apple, which I'm not sure at this point if we do. It's kind of like a shooting from the hip on the discussion. Anyway, so another way is to protect unrealized gains. So when the stocks made that huge rally, in a sense, and we want to protect those gains, but we don't necessarily want to get out of that stock right now. It could be topping off and we think, hey, it's going to make a bit of a correction here. I'm going to buy some puts. And it doesn't even mean that you actually have to get rid of that stock, by buying those puts. You can just trade around, your core position, especially if you've had a stock in your IRA or even in your trading account or your portfolio for 5-6 years, let's say. Well, it's probably had some substantial gains, and you may not want to take that tax implication by getting out of that stock. You can trade around this if you think there's going to be a bit of a correction and protect some of those gains in a sense. Also, stock restrictions. You're unable to sell the stock. So this will happen a lot of times if you're working at a company, let's say, and they aren't really keen on you selling the stock for, a year and a half. It could happen with a startup. It could happen, for instance, one of the best examples of this is Mark Cuban back in the day when his, what was it, broadcast.com or something like that, that he sold to Yahoo for billions of dollars or whatever. That at the time was a really big deal. It was happening over at the CBOE. He had stock restriction on selling his Yahoo. And if you guys know where Yahoo is right now, it's not nearly where it was when Yahoo bought Mark Cuban's company. It was actually trading around $250 a share. And Mark Cuban was restricted from selling those shares for, I think it was like a year and a half or something like that. So what did he do? He went in and started buying puts on his stock. Okay, so he started buying puts, and he basically was buying these puts where it synthetically was getting him out at $240 a share. So he was willing to take a $10 loss on where Yahoo was currently trading because he couldn't legally go out there and sell these. But there was nothing in his agreement that didn't say, that said he couldn't buy protective puts on these, and he did. And that was actually literally, I don't think I've ever seen anybody pick a top better than Mark Cuban picked the top on Yahoo. And that was a really big deal on the floor that he was in there buying those protective puts at the time. And he basically got out of all of his stock at 200, somewhere between 200 and I think it was like $20 and 240. So he didn't sell them, but somebody took them from him because he put it to him. So, but he didn't sell them. So that's a way to kind of get around that, but make sure you really read into the devil of the details whether or not you can actually do that. But he was unable to sell it, but it didn't keep him from putting the stock to somebody. All right, and protecting from tax implications. You can talk to your accountant about this. This can help you when you're staying in the stock and stuff like that. That's what I was kind of mentioning earlier. You don't want to take that tax implication, but you don't also want to miss the selling opportunity in a sense, or the sell-off, or take advantage of some downtime or downside on your stock that you're long. So you can buy these puts, the market makes that correction, you just kind of get out of those puts and you've basically paid for a portion of that loss in a sense. It's not going to be 100% all the time, you guys. And the reason why is because we aren't going to be doing it as 100 deltas. Now, if you guys remember back, we've kind of done a couple of earlier webinars and we talked about deltas. And so just a refresher on what delta is. Delta is, if we look at a stock, let me just pull something up real quick. Let me pull up my trading platform here real quick and find something that we can talk about. So this is the trading platform. Option montage is what this is kind of called. So when we were talking about deltas, so if I buy a stock, let's just say anything, let me just find Amgen, I don't know, it's something. So if I go out and buy Amgen, right, and I buy 100 shares of Amgen, that's 100 deltas, because for every dollar Amgen goes up, I make a dollar. Every dollar goes down, I lose a dollar. Okay, so that's 100 deltas. Now, when we're looking at this, buying a protective put, if we were long this particular underlying, and I'm going to buy something like the, 9 or 13 delta between these two, for every dollar this underlying goes down, my put options are only going to increase by 13 cents. So delta tells you how much for every dollar move the underlying makes, how that affects the premium here. So, and that's all other things being equal. That's volatility remaining the same. There's no days, or there's no theta decay, things of that nature. So like in the next minute, if this were to make a dollar move, these premiums would move by that 13 cents. Okay, so delta is going to affect this premium, and we're only 10 deltas. So it's, if this underlying moved down $1, well, you can imagine, we lost 87 cents on that down move, right? But we're not looking to capture all of it necessarily. We're just looking to capture a portion of that move down. I mean, if we were worried about capturing every dollar move down, I would suggest getting out of it, because that means you are really bearish in this underlying. And if you are really that bearish in the underlying, then I would just walk away from it. So, but having said that, we're just looking to put on a little bit of protection for a little bit of money, so that we can sleep better at night, in a sense. Okay, so that's a little bit of a tirade on delta. Okay, so we're looking to minimize theta contraction. That theta contraction is something. Theta is what we used to call on the floor as the thief in the night that would come and steal your premiums. Now, as an option seller, you want that thief, ransacking that house. But when we're buying options, we want to minimize theta as much as possible. So like, if you guys watch the daily market commentaries, things of that nature, you guys know this is where I like to sell options premiums. But that isn't conducive for buying options premiums, because this slope here kind of gives you an indication as to how much theta is going to come out of your premiums given a certain amount of time. So as you can see, the option price, or the premium, goes down every day due to that theta contraction, and it actually really speeds up in here towards the end. So we want to stay as far away from that as we possibly can, and we want to get out here on the curve, 90 some days out. That also will allow us to capture the next earnings, so we're going to go out here and try and capture some of that expansion in volatility. And when volatility expands, you guys, what it does to this curve is really it kind of flattens it out. So it kind of comes like this, and volatility starts pumping it up, and it causes this curve to flatten out a little bit more, because those premiums are going up, or pushing up on that curve in a sense. It's kind of like a balloon. The bigger the balloon gets, it flattens out the curve a little bit. So that's what's happening to as volatility comes in. And that's another reason why we want volatility to come into this rather than buy it when there's really high implied volatility, because if you buy it when there's high implied volatility and it comes out, that's what happens to your premium. Okay, you get stuck a little. So we don't want that situation. And the only way to really know is if we don't really know when volatility is going to expand or when it's going to contract, right? I mean, we just really don't know that. But one thing we do know is that when it is really low, it is going to have the probability to go up, right? I mean, it's going to want to go back to the mean is what we find. And the same thing when we have really high implied volatility, it's going to want to revert back to the mean. It doesn't stay at really high levels of implied volatility for real long extended period of time. Same as it's really low implied volatility. It doesn't stay there for a really long extended period of time. It's not to say that it can't go lower. It can, but we're looking at the probabilities here of whether it's going to go up or down, and it's a higher probability that it's going to go up when it's really low. All right, and I've mentioned this, we'd like to see volatility expand, which is what I kind of showed in that chart here, was we want volatility to expand so it pumps up those premiums a little bit. All right, so one of the things with this is max profit is obviously unlimited. You know, if the market continues to go higher and this underlying goes higher, then your profit is unlimited in that stock can go to the moon, right? So your purchase price of the underlying plus the premium is where your profit starts generating from. So in a sense, that's where your break even is too, right? Which we'll talk about here in a minute. But your max loss is limited though. Your max loss is limited to the purchase price plus the premium minus that strike price, okay? You have to remember that because you paid a premium for this particular underlying, you do have to kind of add that into what your purchase price was. But your out is going to be at the stock price, or at the strike that you picked if you wanted to put that to somebody. All right, and as mentioned, break even is the purchase price plus the premium. So this is what I'm talking about. When you do this several times, like multiple month after month after month, all of those premiums added into the original purchase price is where your break even is. And you have to keep that in mind and keep track of that too. So that, you know what your yield is or what your return on investment is with this particular underlying. And this is just a little chart to give you an idea of some of that with the protective puts at expiration. And this is, obviously, like I said, at expiration, not to say that we're going to ride these all the way into expiration necessarily. So if the stock price, declines to where our strike price is, we can't lose anymore. Whereas this little green line here is if you just had the stock and it went to zero, right? And if it continued on its uptrend. But one of the things is we got to remember that premium that we paid for it. I talked about in the previous slide that it's the premium or what we paid for the stock plus that premium. Okay, in a sense, that's that gap. We can't make up for that ever really again unless you start selling calls against it or something like that to lower that overall basis. But I'm not going to get into that so much today. But just remember that your upside is going to be limited by that premium you paid for the actual puts. Okay. Does anybody have any questions so far? It's pretty cut and dry for the most part, right? So far. Okay. So I'm going to pull up the platform. This is something like if you guys have something in your portfolio and you want to look at it to see if it kind of falls in line with the rules of what we're talking about here. I'm not sure why my platform won't come up right now. Why it won't come in and over my thing here. Let me see. For some reason there. Oh, here. Let's see. All right, let's go to this one. All right. So pick a stock. Let's just kind of, so far, no questions. Guess is what that is. I got in a few minutes later. You explaining a single put. I'm explaining a protective put. So this is assuming you have the underlying, you're long the particular stock and how to protect yourself, especially going in and around earnings and stuff like that. That's really where I like to come in with this particular strategy, is for an earnings event. So I protect myself on the downside. And I gave the example, let's look at Apple. It actually has high implied volatility, so I wouldn't necessarily want to do it. My rule for this is basically we want something that is below 30. That gives us the opportunity to see implied volatility expand, and rather than contract. So my charts are, my computer wants to be slow right now. All right, would you buy a put for GE? Yeah, I'll look at, hopefully look at a put for GE if once this thing loads up. I don't know why everything's going so slow right now. It's kind of frozen for me. So I'm going to have to take a second for this to come in. So one thing I want to mention, I'll mention a couple of things before we get going. One thing I like to do, so, okay, if we're long 100, if we're long 100 of the underlying, okay, even if you're long 1,000 of them, but if we're long 100 of the underlying, keep in mind that each one contract that we purchase on the option montage, one contract is equivalent to 100 of the underlying, okay? So for instance, when you're buying like a married put and stuff like that, you'd buy 100 of the underlying and then you would buy one put. Now with this, this is something that I'm looking at because I own the stock, right? And I'm kind of trading around my core portfolio. My core portfolio is the stocks that I really like, right? I don't necessarily want to get out of them all the time, but I will trade around them, especially, you see a technical setup. NVIDIA might be a good example of, if you've been long NVIDIA and it's made this rally. Basically, a lot of this rally has been based on the cryptocurrencies. So the cryptocurrencies use a lot of NVIDIA products for the computers that are running all of these mining operations, okay? Well, they've talked about moving over to the cloud, which would hurt NVIDIA. So if you've made this run in NVIDIA, and I don't know when that's going to come, it's just, that's the hubbub around, on the street, is that they might be starting to move away from these video cards. Excuse me. So maybe I want to protect some gains on that type of thing. And this is basically where some of that, hubbub was coming out about. So if I wanted to protect NVIDIA, let's say I'm long 100 shares of NVIDIA, okay? And I'm just going to base it on 100 to make life easy. I'm going to go out here, and I already have puts on in NVIDIA for full disclosure. But I'm going to try and go out. I like to go to the quarterlies. There has a tendency, especially when you get further out, a little bit better markets, people have a tendency to trade the quarterlies. I don't know if that's just a floor thing, though. It could be. We could do the June. June's also a quarterly. But having said that, I like to go to around the 10-ish delta. The reason is because I don't really think that I want to pay a lot, but there's also, you'll get better bang for your buck in a sense. If you were going to buy these like 190s or something like that, there's 39 deltas. So for every dollar the underlying moves down, 40 deltas, I'm going to get 40 cents. So I'm covering half of that move down, right? If it was 1 for 1. Well, I like to go down here to like the 10-ish delta, and let's say I bought 4 of these. So I'm basically paying $8 for these, right? I would be paying $8 for 40 deltas, because remember, now if I do 4 contracts, I only have 100 of the underlying, so I'm kind of over hedging in a sense. But because you're the buyer of the option, you don't have to worry about the assignment necessarily, because you have the right and not the obligation to assign these. So that's the beauty and when you paid for the option. Okay, so if I was going to do something like this and protect, I don't want it to go down below 190, and that's where I'm kind of want to be out or whatever, and you're thinking about, okay, it's 40 deltas, I'm going to capture half of my money on the way down. Well, you're also paying $10 for that. Okay, whereas if I go down here and buy 4 of these, all right, I buy 4 of these, I'm paying $8, so I'm paying less. And one of the things I'm looking at is also I'm not wanting to necessarily get out of all of my stock. So if I buy 4 of these for $8, I'm 40 delta. So that means for every dollar move down in the underlying, I'm increasing my premiums by 40 cents. The same thing, but I paid less for it. Yes, I have a lot further to go. I have to worry about other things of that strike not going into the money and stuff like that. But, you know, the other beauty in this is you know, being a trader of options, you know, you can play around with these. The market comes down, and I also talk about how delta is the probability of the underlying being, or this delta is a probability that this strike will be in the money at expiration by 1 penny. That means in the next 77 days, there is an 11% probability that NVIDIA will be trading 159.99 on expiration of these March contracts. Okay, did I lose anybody there? That's what delta tells you. So there's a higher probability this one's going to go into the money, but I don't necessarily want to get out of the stock either. But there's another thing to look at, is how does this value change, right? So I was looking at these 160 puts and the 190 puts, okay? So let's just say the stock price decreases by $10. So let's say it goes down by $10. So those puts go in the money, right? If we look at that. So it decreases, but stock decreases by $10. Okay. And we could probably add a couple of days to it, but let's just leave it normal for right now so we can see what happens to these premiums. So these went from $10 to $14.50. So we got an increase of $4.50. These $2 ones went up by $1.33 only, right? So they went up by $1.33. But remember, we have 4 of those on. So if we do 4 times $1.33 and do 4 times $1.33, I probably should be able to do this math in my head. And by the time I do it, I get it. So it increases by $5.30 for that same $10 move down. Okay, and that's with everything else being equivalent, like no time really went by. But just to give you an example, to give you an idea as to why, another reason why I like to go down here for these. You get that $10 move down, I actually made more money on these down here. $5.30 instead of $4.50. I made another, you know, 80 cents or so, right? So I did better by going down there a little further away, and that's without, you know, time elapsing and things of that nature as well. But to keep in mind, to be clear, that's another reason why I go down here. I buy a few more of them, and I'm going to have to pay a little bit more in commissions by doing this. But it also opens up a lot more opportunity to trade in and around this. If the market does make that correction, does go down there and touch those 160s. You know, if the market came down and touched my 160s, I would most likely take 3 of those 4 off as soon as that happened, capture that gain. And then in a sense, I'm having these 160 puts on for free, right? Because my profit on those other 3 paid for those 160 puts. I'm good. Market continues to go down. I'm rest assured I'm out at 160 if I really want to put it to somebody. And then if the market comes back up and away, I never had to get out of those stock and never really had to worry about the tax implications and things of that nature. All right. But the real takeaway here is, if you're going to do like 4, is usually what I like to try and do, get about, you know, half the deltas, you know, of the underlying. So, you know, if you're long 100 stock, that's 100 deltas. If you are long, you know, 500 stock, you're long 500 delta, right? If you're long 1,000 stock, you're long 1,000 delta. So that you need to take that in mind as well, or take that into account as well when you're doing this. Is, you know, multiply those deltas. Does that make sense? All right, Dave, you got to slide out. All right, thanks for participating. So that's really important takeaway with this. So I like to go a little further away, buy a few more, and if that happens, to go down there. Now, another thing to keep in mind, when this market goes in our direction, let's say for instance, the market does come down to us and our puts start going really deep in the money, right? If they're only just in the money, I'm not going to probably deal with the assignment and stuff like that, and I'm not going to probably roll this out when they're just slightly in the money like this. I'm going to get out of this trade for a profit. If they're really deep in the money, and I want to keep that dream alive a little bit, you can see that there's no extrinsic value in the deep in the money option. So check your corresponding calls to determine how much extrinsic value. That's a little floor trader hack for you guys. In the money options have intrinsic and extrinsic value. Extrinsic value is basically theta decay, and intrinsic value is what this strike is worth in relation to the underlying, right? So if it's 120, then it's trading 200. These are basically worth, it's trading 190, 196. So these are worth $24, right? They're right around $24 just off the top of my head, because that's the difference between here and there. And then you can figure $24 minus this, that gives you about $5 and some change in extrinsic value. And the easiest thing to do is just look right over here. The corresponding calls tell you what, because these out of the monies are all extrinsic value, right? But a floor trader hack is this extrinsic value of the calls is also the extrinsic value of the puts. It's very close, you guys. It's not perfect, you guys. It is very close, and so I don't have to do the math all day long, every day. That is the easiest hack. I just look over there and see how much extrinsic value there is. I don't care about a nickel here or there. So that's a little hack for you. But when they go deep in the money, this would be the only time I would think to roll these out, because remember, I don't want to continue to add to what I overall paid for this underlying. But if I only have to pay or add in an extra 10 cents or something like that, then I might just do that and protect myself. And the other thing is, when you get that far in the money, that's basically going to be acting like 100 deltas. So for every time it moves down, you're getting paid dollar for dollar in a sense. It's not perfect, but you can see these are like, these probably should be higher deltas than what they're showing, but it's going to be basically, 90 some odd deltas. So for every dollar move down, you're capturing 90 cents of that, right? All right, so if unsure of the direction, would at the money straddle be viable protection, or would that be too expensive? If you're going to buy, I would not buy a straddle around the underlying, no, not necessarily. Because unless you're thinking about adding to that position at that price. I think it would be very expensive, though. The thing with a long straddle is you have to have a pretty major out move in order to, make up for that, what your premium was. Like this would be like $26 move to make up for the premium that I have to have. So I need NVIDIA to move $26. So that's pretty expensive. And, so I like to go a little further out of the money, right around that 10 delta. Low probability of it hitting, but, it gives me a lot more room to trade in and around it. And I like to trade in and around these when I have these around my underlyings. Okay. And do it well in advance of a binary event. So something like NVIDIA, if we go to look at the charts, I don't know if it's going to show it on here, but I'm going to show you that their earnings are going to be like right in here. So buying that March contract is going to be perfect for that. Taking advantage of that earnings event. And somebody actually, I didn't get to GE. Let me get back to GE and we'll run over it real quick. One thing I failed to mention in this one, that will still go in on, your essentials to success, like I've talked about in some of my other webinars, you guys. Essentials to success are key with all of this stuff. One of those being, you know, we want low implied volatility percent. GE's got a 58 implied volatility percent, so it's a little bit high. But any stock that's under $100, I go to the nearest monthly expiration to come up with this little hack. Is a stock under $100, you look at the bid offer on the puts and the calls that are closest to the at the money in a sense, and we want those to be less than 10 cents wide from the bid and the ask. So the bid to the ask here is 1 penny wide. Very tight markets. GE trades a lot. There's a lot of participation in here. If it's over 10 cents wide on a stock under $100, I wouldn't really get into this because you have to give up so much edge to get in and so much edge to get out. And if they go into the money, those get even wider. So it makes it very difficult to get out of stocks that aren't traded readily. And then any stock that's over $100, my IWM isn't really a stock, but my rule of thumb here is any stock over $100, you move the decimal point 3 ticks to the left, and that's how wide the bid ask should be. So 15 cents. Now this is going to be tighter than that. It's like 2 or 3 cents. So that would fit the rule. Nvidia, $200 stock. So about 20 cents wide from the bid at the ask. And right now it's a little bit wider than that, but Nvidia, oh, that's because we're not in the, you go to the ones that are nearest to the expiration, and you should see that they're about 20 cents wide. Usually Nvidia is a little bit tighter than this, but a Friday heading into the end of the year, there's probably a lot of canceled orders in there. So Nvidia does usually fit that rule. But follow that, you know, anything, we look at Qualcomm, it's a $60 stock, so it's got to be 10 cents wide. So you can see that it's 3 cents wide, so that fits the bill. You look at something like Aon. Aon doesn't always have great markets, so it's 10 cents wide though. It's over $100 stock. It's 10 cents wide. Sometimes these will get a little wider, you know, especially further out. You can see they're getting a little wider. And that's another thing. If they're wide here, they're just going to get wider the further out you go. But my rule of thumb is 10 cents wide to the bid ask on anything under $100. Over $100, move it 3 ticks to the left. That's how wide it should be. Okay, so keep that in mind. Don't just do it on any stock that you may have. You know, maybe you know of a small biotech stock or something like that. They may have options on them, but the bid ask is really wide. Just stay away from it. It doesn't make sense to take that risk. Okay. And I like to go for like that 10 delta so I can play around with it a little bit more. But the rule is, goes deep in the money, very little extrinsic value. That's when I would roll them out. Otherwise, I'm going to cover these before. Because for me, anyway, and you'll have to check your commission structure. For me, to put my stock to somebody, for one, like take those puts into expiration and have that stock put to somebody, that is more expensive than me selling out of my option, getting out of my option position and selling the stock. Okay. It's going to be, the commissions is going to be more than that. So you're going to have to weigh it a little bit. Okay. And weigh how much your profit is versus whether it's worth it to pay the extra money to put it to them. Because, you know, the market could be going down and you're only getting, you know, 75 cents for every dollar move. It might make sense to put it to somebody at that point, because those, especially if you're doing larger quantities, those, you know, 1,000 lots and stuff like that, those pennies are going to add up to a lot and may be offset by putting it to somebody. So just be mindful of your commissions in and around that. I usually like to keep my core position and not mess around with it and just get out of the puts that way. Does that make sense? So on GE, for instance, to go a little bit further, let's go back to GE. I think I had a little bit high implied volatility yet. So excuse me, a little tickle in my throat. See when their earnings are, because their earnings might be coming up relatively soon, probably right here. So the volatility has started to go up a little bit. Actually, you know, it may very well, it looks like it's kind of bottomed out. It may be starting that run where volatility starts increasing heading into this binary event here, because that's what we usually see happening. You can see here it makes a long run trudge up into the binary event. For the most part, it wants to rally up into that binary event. Now they took a big, I don't know why their volatility is remaining so high, but that very well may be the case. So because their earnings are right around the corner, that might be a good time to do it if you're expecting volatility to expand, which I probably would be. Can you show how you would set the put you're referring to up? Yeah, so let's just say we've been long GE. We're worried about it to continuing to go down at this point. Probably would pull a ripcord, but we're worried about it going down even further. So I would look for those 10 deltas. I'm already long the underlying, right? I'm already, say I'm long 100 of the underlying. So I would go in here and buy probably like 4 of these. So I would go in and just buy 4 of them. And the reason why is because I'm trying to get those deltas, right? I'm buying 4 of them, so it's going to cost me 4 times the 13 cents. So it's going to cost me 52 cents, right, for those. And if I was going to do the 40 delta, it's costing me 60 cents. So I'm saving money there. I'm also getting more deltas, actually, because I'm getting 4 times this. So I'm getting 4 extra deltas than I would be getting here. So I'm paying less, and I'm getting more of the market. I'm capturing more of that market move if it goes down. So I want to take advantage of that as well. And if the markets start moving up, I can kind of like peel 1 or 2 of them off and stuff like that if I wanted to. Or if it comes down and touches, 15, I would most likely get out of 3 of these 4, because I'm definitely having on those 15 puts for free now, because all my increase has taken that into consideration, right? These things are going to be worth probably close to 40s. $2 move down, it's going to be closer to 50 cents what these are worth. All right. So, that increase is totally paid for the whole trade. So it's pretty easy to do that. And then, there's only a 10% probability it's going to be there at the expiration. But if it does continue to go down, you can get out at 15, either synthetically by just getting out of them or by putting it to somebody. Did that explain it? Okay. So that's how I play it. A lot of people will tell you, go when you're doing a protective put, buy it like right here, just below where the underlying is trading. I don't like that, for one. If I was worried about it going down to 17 and going below 17 at that point, it's kind of like, why wouldn't I just get out of the stock if I'm worried that much about it? If I'm not really worried about it, but we're heading into a binary event and I don't want to take that much risk. If it goes below 15, it's kind of like, if it goes below 15, I'm thinking, all right, that's probably where GE is done for. And it's probably going to go to 10 or something like that. So I want to be out. Like, this might be that place where I'm like, this is where I would put my stop. You wouldn't necessarily put your stop at 17, right? I look at protective puts as kind of like, instead of using a stop. I don't like using stops ever. They just you get run over on them. And the beauty in this is, it's like, it's a stop because I can be out at 15. If it goes to 10, I know I'm out at 15, but I don't have to pull the trigger. Whereas a stop, it goes down below 15, you're out at wherever it put you out. But the puts, it opens up one day and it's trading down at 10. I know I can be out at 15 because I have the right to put it to somebody. So I know I can get out at 15. You don't have to worry about where it opens up, where it gaps down. The market, there's no participation underneath here, and it's a free fall. You're out. You paid for that peace of mind, but for 10 cents, that's a pretty good peace of mind. And then, of course, you did it 4 times, so it's more, you're over hedging in a sense. But you're over hedging because you're buying more puts than what you actually own. But, you're also, in a sense, under hedged, right? Because if the underlying moves down $1, I've only captured 40 cents of that move, because 40 deltas, I only increased by 40 cents. Whereas it's going to increase more than that because of gamma and stuff like that, but I'm trying to keep it simple. But I'm only going to capture a portion of that. So it is slightly underhedged in a sense. Okay. So everybody pretty much got that? And this is brilliant to be able to trade around, especially, Apple has earnings coming up and it has high implied volatility, but that would be one that I personally would be a little bit worried about for a market correction. Tesla, I would always be worried about it, but I don't understand Tesla, so I don't have that as a core position in my portfolio. But try and go with low implied volatility, because like we looked at a lot of those charts. Let's see if the GE wasn't a very good example of it, but I'm sure Apple would be pretty good example. And Apple's aren't, so we're kind of coming into that earnings season where a lot of these are going to be landing in January and stuff. So we would be able to take advantage of implied volatility going up. As you can see here, it has a tendency to make its highs right there in and around the earnings. So it rallies into earnings for the most part. So this is the volatility expansion I was talking about wanting to capture. So we aren't going to get all of that, but heading into this earnings event at the beginning of the year, we probably could see volatility expand. So that's got to be your assumption. I say I like to do it in ones that are below an Ivey percent of 30. If your assumption is volatility is going to expand because the earnings event is right around the corner, then that's one thing. And if you do that, just beware that you're going to see this happen right after that earning event, and that volatility crush smashes premiums. So if you're not directionally right, you could have ended up losing money too, right? And possibly even if you're directionally right, you might still not make a whole lot of money on it because of that volatility crush. So that's the problem with volatility crush and being long options is you can be directionally right and still not make money. Where the beauty in taking advantage of high implied volatility is you can be directionally wrong and still make money. So that's the beauty in selling options premium, but that's for a different day. This is for, just keep in mind, if you got into it where it's really high implied volatility, like some people talk about buying puts right before the earnings. Well, even if the market went down, you bought it at where the premiums were pumped up the most, which means your 10 delta option was really far away from where the underlying is trading. And then you paid a lot for that premium because of all the volatility. When that volatility comes out, that premium comes out too. It's like that balloon I talked about. You blow up the balloon, it flattens out the curve, you let go of the balloon, and all of it comes out. All the premiums come out of it. Okay? So, you heard me talk a lot about probabilities, like when implied volatilities, low probabilities are, it's going to revert back to the mean, right back here around middle, which is what this has done. But probabilities heading into a binary event are very high that volatility is going to continue to go up. As you can see, it almost always goes up into those events. So we want to take advantage of that high probability scenario of volatility expanding. And when volatility expands, we get the premiums pump up. That's another thing I can show you on this thing here with the theoretical stuff. If we go back to look at theoretical price and market stuff, we did a $10 drop, but let's just get rid of that $10 drop and just say volatility expands, by 20%. You can see that the premiums, with the market not even moving, the premiums go up, right, from where they originally were. That went up, that's a really big increase in the premium. So even if I was directionally wrong and the premiums went up a lot, the volatility really expanded going into the earnings event, I might even cover these for that as well, right? Because the market didn't move, the underlying didn't move, I didn't change where the price went, it's just volatility. And that's that volatility pumping up these premiums. And keep in mind, if that volatility was at the highs, like right before the event, these premiums are pretty beefy. I'm buying basically a strike $15 below, or actually more than that, like $35 below where I bought these for in low volatility, right? So if you're buying it right before the event, like 7 days, 5 days before the event, you're paying a lot of premium to volatility. So we want the expansion volatility. And if you get that expansion, the market doesn't move, and I had done those 4 lots and I'm going into that binary event, again, I would probably go and cover 3 of these. Take my profits on those, ride the one out or ride the amount out that I have in underlying. So if I had 200 stock, then I would get out of all but 2 of them for that event, and then ride those out, because then I've captured at least most of the volatility and price and stuff and paid for those. Is there a calculation for delta which includes Ivey to estimate or calculate based on future assumptions? That is a good question. I don't think that there is, but there might be something out there that I haven't seen. But you can assure yourself that this is probably, with this implied volatility, this is probably right around a 10 delta option with that implied volatility pumped up. So, when you're doing the 10 delta deal right before an event, it just isn't as good of a time to do it as when there's lower implied volatility. And vice versa, if we see that volatility goes down by that much, you're going to see, it doesn't always work very well with this, but volatility will eat away at it. Okay. So basically trading with probabilities of being in the money by 1% is 10, like I said, probability of this strike being in the money at expiration by 1 penny is an 11% probability. But the reason why I want to emphasize when I cover those, because the market comes down and touches that price, touches my 145, I'd get out of 3 of those, because your probabilities of being touched are twice as great as your probabilities of being in the money at expiration. So it's about a 22% probability that I can get the market to come down and touch those. I've beaten the odds, right? I've beaten the odds, so I'm getting out. And that's how I play basically every trade. If I can beat the probabilities, I'm out, and I play to be ahead of those probabilities. So basically this course, all my webinars, I talk about this stuff. You guys should really be trading with this kind of knowledge. I mean, this is 20 plus years of hard knocks, me learning to trade basically on the floor. The mistakes that we made, I've tried to come up with very solid rules to keep you mechanical, to keep you in the game longer. So, the best way to become a better trader is to constantly learn, which you guys have obviously taken that first step by taking this webinar. But wouldn't you say that knowing how to create an option strategy, like just buying a protected put, anybody can tell you how to do that, right, online. But they aren't going to tell you the probabilities and how to increase your probabilities of success. And that's exactly what I do. And I teach that in every single one of my webinars. So even being a technical trader isn't enough to create consistent winners. But the way I teach is talking about probabilities. Vegas is a perfect example of everything in Vegas, the probabilities are in their favor. The best probability game you can get out of Vegas is the coin toss on a football game to see who is home or who gets the ball first. That's your best odds because it's 50-50. Best odds in Vegas. Everything else is weighted in their favor. So that's the way I try and teach, is how to get those odds, the probabilities in your favor. I teach that in here, how to use Delta, measure your odds of winning. I kind of went over a few of those things. How to trade using gamma, which is important, that market profile, how to trade using some of that technical stuff that is really more psychology of the market as far as I'm concerned. Protecting your portfolio against rising interest rates. We are in a rising interest rate environment, you guys, and we've been talking about portfolio and hedging portfolios with the stock and stuff like that. If you have bonds in your portfolio, you guys, and these interest rates go up, you are probably already seeing the value of that bond portfolio go down. And it doesn't take much of an increase in rates to really hurt the value of your bonds. Yeah, you can hold them to the end of the day and get par for it, but if you have like an ETF and or are like the average person who only holds a bond for 7 years, then by the time you go and sell that bond's going to be worth a lot less than what you paid for it. And you can't chase yield. You might just be like, well, yeah, I'll just sell my bond and I'll buy a higher coupon so I can get that coupon payment to pay it. You can't chase yield. That coupon will never pay off the amount you lost on the bond you sold early for a loss. It just can't be done. So I teach the probabilities, and when the probability has gone against us, how we stay mechanical, increase those probabilities even further in our favor, which is kind of like what I'm talking about with that, trading in and out of these protective puts in order to increase your probabilities of success and to generate some income in and around that as well, because a lot of times this stock is going to continue to go up. So, the beauty in buying those extra couple little puts is when it goes your way, or, you are correct in putting on those protective puts, it'll help pay for some of those other ones that you didn't have go that way. All right. So we're offering this trial today, and I suggest you guys all take advantage of this. I should have it in the chat window. Let's see if it's in the chat window already, or if I need to add that. I might need to add that real quick to the thing real quick. So right now you could actually pause this video, and if you're watching this on delay, and just type this into your URL if you're getting sent this. Thanks, HH. Happy New Year to you too. Appreciate it. But let me get this over into the webinar. So let me see here if I can get this pulled up real quick for you. I forgot to copy and paste that before I went into this. So I'll do it real fast. Get that in there for you. Let me know if you guys can see this. I'm putting it into the chat window. We've been talking back and forth on the questions box. I threw it in the chat window. I think it went to the entire audience. So you can easily just click on that, and it'll pull up a browser and you're good to go. But really good deal for pretty cheap, and this protecting your portfolio against rising interest rates, well worth it in and of itself. But 10 hours of coverage in all this, so it'll easily pay for itself, I'm sure. All right? So keep in mind, when you're using the right tools for the right situation, you guys are going to be more productive state of mind. You're going to be able to put on more strategies, which is going to create more opportunities, and ultimately it's going to build your confidence, and that's what this is all about. So trying to work you guys through that. Take advantage of the daily market commentaries, you guys. I talk about every single trade I do every single day, when I take them on, when I put them on, when I take them off. Whether it's a winner or a loser, I'm going to talk about it the same. Actually, I'm probably going to talk about the losers more than I'm talking about the winners, because those are the ones I'm staying mechanical with. So I'm not cherry picking trades, you guys. I talk about every single trade I do, and whether it's in my IRA or in my margin account too. So, all right, that's all I got for you guys. Have a great weekend. Happy New Year. If you can't take that, take it easy. All the best, Edward. Take care. You too, Mike. Thanks, Bob. Appreciate you guys. Thanks for all the kind words, you guys. Take care. Thanks, Chris. Appreciate it. Hey, Scott, to get the daily market commentary, just call us at 310-598-6677. They can set you up with it. I don't know exactly where the link is and stuff. I don't have that on me right now, but send those out. Cool. Take care, guys.